funding advantages that too big to fail organizations have over others amounted to $250 billion for the 28 largest banks in '09. At the Federal Reserve Bank of Kansas City, he says, we estimate the ratings and funding advantage for the 5 largest U.S. banking organizations during the crisis. And in '09, these organizations had senior long-term bank debt that was rated 4 notches higher on average than it would have been based on just the actual condition of the banks, with one bank given an 8-notch upgrade for being too big to fail. Looking at the yield curve, this 4-notch advantage translates into 160 basis point savings for debt with 2 years to maturity and over 360 basis points for 7 years to maturity. This is huge, and it has a highly distorting influence on the market. Now, I also noticed, Mr. Trullo, you argue an ancillary rationale is that additional capital requirements could help offset any funding advantage derived from the perceived status of such institutions as too big to fail. We had a hearing yesterday regarding too big to fail, and I think some very well-meaning people believe that the problem is solved by this new orderly liquidation authority. And of course, according to their logic, because of the new authority, the institutions will not be perceived as being bailed out, and the rating agencies will downgrade those institutions, which is going to lead to higher borrowing costs, thus eliminating that status. But I don't believe many of the Fed governors believe this, and I don't believe many in the market believe it. And I'd start with you, Chairman Baer, and ask you for your perception on this. And how do you believe orderly liquidation authority impacts the size and scope of this global surcharge in the future, and this global systemically important financial institution surcharge?
Well, I would just say too big to fail was a problem pre-crisis, and there were bump ups there, and then these were made to. The problem is that the bailouts reinforce the perception, and so we've seen even widening disparities in funding costs between small and large institutions. I think we're making progress already. Moody's has announced that a number of banks are on negative watch for downgrade, and they're actively considering removing the bump up.
They said they may. Yes,
they may.
I saw
That's
that.
right. And I think, again, as we've discussed before, the FDIC and the Fed, through implementation of the living will requirement, and us through our liquidation authority, have the case to make and will make that, yes, this can work, it will work, and bailouts will be a thing of the past. Too big to fail was well ingrained into market thinking pre-crisis. It's been with us for too long. It's going to take some while to get rid of it. But I do think Title II and Title I give us the authorities to take the steps to get rid of it over time. It's going to take some time, but I do believe that. And I think, I don't also see any alternative either. I think.
Let me then go to Mr. Trullo for his thoughts.
Mr. Royce, I think, as Sheila, I'm going to say, Chairman, for the next 22 days, every time I address her as Chairman Baer, I think Chairman Baer has already made the point that it's not an off-on switch. That is, we've got the Orderly Resolution Authority in place now, which the FDIC is implementing. I think, as I've suggested, the capital standards are a complement to the Orderly Resolution Authority. And in order to get to market discipline, I think actually both of these things are going to change. I mean, if you think about it, if you end up in a situation in which counterparties truly believe that there's not going to be a bailout forthcoming, those who advance credit to very large organizations are going to demand higher levels of capital than existed in the past. And so I've regarded the Resolution Authority and the SIFI capital surcharge as complementary self-reinforcing mechanisms which can move us along the road to what I think everybody up there on the panel and everybody at this panel agrees with should be the end, which is eliminating any too big to fail reality or perceptions.
Well, I agree that should be our end goal, and the one concern I have is the way in which the legislation was written. I'm afraid in some ways we may have reinforced it. And I say that because counterparties, well, you can see it right now in the market. I mean, clearly at the moment, things have not changed in terms of the way too big to fail is being perceived, and you see it by the basis point spread in the market. but